Here's how not to invest in stocks. And when I show you this, it's going to look really like, duh, why would you do that? But if you pay attention, this is what a lot of people do when they're investing in stocks, okay? Here's what not to do. So you've got your stock, and let's say the market opens, and all of a sudden the stock goes up 10% for the day, which is a pretty big jump, okay? Goes up 10%. All of a sudden people see that when it opens and they're like, oh my gosh, it went up 10%. I gotta join them. So then they buy off of no reason other than the price in the day went up. Okay? No other reason than that do they buy. And then them buying drives the price up even more and even more and even more and even more and even more. But this is why day trading and other things like that, like algorithms and some other stuff that I mentioned like yesterday, is that's why you shouldn't listen to that stuff. Just because a stock goes up for the day doesn't mean that it went up for a sound fundamental reason. Okay? You cannot base your investing strictly off of what the stock has done in the past. Stocks are priced off of what that company is expected to do in the future. So typically what people do is they'll see it do that 10% jump. They'll buy it, and then more people will buy and more people will buy, and it will continuously drive the price up. And then what happens is when it starts to go down, they're like, oh no. And then they sell, and everybody starts selling, and everybody starts selling, and everybody starts selling, and then the fear kicks in, and now you've already sold. And then I kind of know what you're thinking in the example that I just gave. Is you're like, oh, well, I'll just be the guy who sells it right here. I'll just be the guy who sells it right there, right before that happens. And then that's how I make my money. My question to you then is, how exactly are you going to know how to time that? How do you know? And how do you also know that you're not the person who buys it right here? Your sole reason for buying the stock was because you saw it go up for the day. It went up, 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 and you bought somewhere along here. How do you know that as soon as you buy it, the stock's not going to do that? What if it did that, right where you bought it right there? How do you know? And this is why people lose a lot of money in the stock market when they try to do things like day trading or use algorithms or look at volatility and implied volatility and all the freaking googly gop that has nothing to do with the value of the company. So when you're sitting here buying just because the stock goes up, this is typically what happens. It goes up, goes up. Let's say you buy it right there. Maybe it goes up a little bit, and then it goes down. And then when it drops below what you previously bought it for, you sell it down here. Loss. Duh. I can understand why people do that because it can be a scary thing if you're literally just looking at the stock price go up and then, okay, looks like the stock's doing good, right? So I'll buy it while it's going up. It's going up. Everyone's making money, right? But when's it going to go down? And then when it does go down, you sell it at a loss because you don't want to lose any more, right? Right? So it makes sense why the emotional person with their money uh, has that happen. It goes up, up, up. They buy it like right there, goes up a little bit more, goes down below where they bought it, and they sell it because they don't want to lose any more. Cutting your losses, apparently. That's not the way to do it. That's exactly why day trading and day to day, week to week, even month to month, sometimes year to year, investing is a very short time period to be investing. When you're investing, you got to be willing to miss that money for 5 to 10 years. Sounds crazy, right? It's not. It's the way to do it.